The art of scaling into Forex positions as an intermediate trader. Introduction. Scaling into Forex positions is a trading technique used by intermediate traders to manage risk, maximize profit potential, and optimize trade entries. Instead of entering a full position at once, traders gradually add to their positions as the trade moves in their favor. Scaling in allows traders to improve their average entry price, reduce the impact of market volatility, and adapt to changing market conditions. In this text, we will explore the concept of scaling into Forex positions and discuss effective strategies for intermediate traders to implement this technique. Understanding scaling into positions. Scaling into positions involves breaking a single trade into multiple smaller parts and entering them at different price levels. Traders start with a partial position and add more as the trade progresses favorably. This strategy is especially relevant in trending markets, where price movements often exhibit pullbacks and corrections. Benefits of scaling into positions. Risk management. Scaling in allows traders to manage their risk more effectively. By starting with a smaller position, traders can limit potential losses if the trade initially moves against them. Reducing market impact. Entering a full position at once may cause significant market impact, especially for large orders. Scaling in spreads the market impact over multiple entry points. Adjusting to market conditions. Forex markets can be unpredictable, and scaling in allows traders to adapt their position sizes based on changing market dynamics. Identifying suitable market conditions. Scaling into positions is best suited for trending markets, where the price is moving consistently in a particular direction. In trending markets, traders can take advantage of pullbacks or retracements to add to their positions at better prices. Selecting entry points. Technical analysis. Identify key technical levels, such as support and resistance, trend lines, or Fibonacci retracement levels to determine potential entry points. Scaling in at these levels enhances the confluence of the trade setup. Market sentiment. Monitor market sentiment and macroeconomic factors that may influence the currency pair's direction. Scaling in during periods of aligned sentiment can provide stronger confirmation for the trade. Position sizing and risk management. Define risk tolerance. Determine the maximum percentage of capital to risk on each trade and stick to it throughout the scaling process. This ensures consistent risk management. Gradual position sizing. Allocate a smaller portion of the total desired position size for the initial entry. Subsequent entries should be larger as the trade moves in the trader's favor. Ensure that the overall position size aligns with the predetermined risk tolerance. Trailing stop loss. As the trade progresses in the trader's favor, use a trailing stop loss to protect accumulated profits. The trailing stop automatically adjusts to lock in gains while giving the trade room to breathe during favorable price movements. Monitoring and adjusting the trade. Continuous evaluation. Continuously monitor the trade's progress and market conditions. Be ready to adjust the scaling and strategy based on changing market dynamics or technical developments. Take profits. Consider taking partial profits during significant price advances. This locks in gains and allows traders to reduce their exposure while still participating in potential further price movements. Scaling out. If the trade shows signs of weakness or the trend loses momentum, consider scaling out of the position, especially if the initial scaling in process was based on a trending market assumption. Conclusion. The art of scaling into Forex positions is a valuable technique for intermediate traders seeking to optimize their trade entries and manage risk effectively. By gradually adding to positions in trending markets, traders can improve their average entry price, reduce market impact, and adapt to changing market conditions. Using technical analysis to identify suitable entry points, implementing proper position sizing and risk management techniques, and continuously monitoring and adjusting the trade are essential elements of successful scaling and strategies. As with any trading technique, practice, experience, and a well-defined trading plan are key to mastering the art of scaling into Forex positions and enhancing overall trading success.